In this video, I'm going to explain what peer-to-peer lending is, how it works, what risks are involved, and what you need to pay attention to before trying it. Please remember, because the main focus of this YouTube channel is investment, ILLB, explaining everything from the perspective of us as lenders, the people providing the money, not the borrowers. So, what exactly is peer-to-peer lending? The word lending obviously refers to borrowing and giving loans. Peer means individuals on the same level or ordinary people. In the IT world, we often hear peer-to-peer sharing, like torrent, where users download files from each other instead of downloading from one central server. Every user is treated as an equal peer. In peer-to-peer lending, the peers are ordinary people lending money to one another. This is different from borrowing from a bank or cooperative, which are formal organizations. Essentially, peer-to-peer lending is similar to traditional offline borrowing, like borrowing from relatives, friends, or even loan sharks. But the difference is that peer-to-peer lending is made extremely simple and scalable thanks to internet technology. This allows us to lend money to many people, even if we have no idea where they live. The peer-to-peer lending platform is basically a website or mobile app created by a company, usually a startup or fintech firm. So, we can summarize that peer-to-peer lending is an online platform that connects people who need money with people who want to lend money. To explain how peer-to-peer lending works, let's compare it with the loan products we already know, like bank loans. Banks collect funds from many people. The cheapest source of funds is customers, savings, or deposits. Banks persuade people to place their money by offering low interest. For example, 1% for savings and 5% for deposits. All the money collected is processed using very complex internal calculations to decide how it will be distributed. One of the ways banks distribute funds is by offering various loan products. For example, mortgages with 9% interest, business loans with 12% interest, personal loans with around 11% annual interest. Banks also determine who qualifies for these loans. If someone has overdue payments at Bank A, they likely won't get a loan at Bank B. The interest difference becomes the bank's profit. Deposit holders do not receive any portion of the profit that borrowers pay. And if borrowers fail to repay their loans, those with deposits still do not suffer losses. Now let's compare that with peer-to-peer lending. Peer-to-peer lending aims to act as a platform that connects people who need money with those who have money. It starts with the borrower registering and stating, for example, that they need a loan of X amount. The platform evaluates their rating. Let's say they are assigned rating A with 14% interest. This loan request is then displayed on the platform for lenders to fund. We, and other lenders, can collectively fund the loan with whatever amount we choose until the target amount is reached. Notice that the platform does not lend any money itself. We, the lenders, earn interest close to 14%, while the platform only takes a fee. But if the borrower cannot repay, we, the lenders, take the loss completely. The platform will simply say, "We are just a mediator." All risks are borne by the lenders. The risk is big, but there are benefits. For the borrower, the main advantages are lower interest rates. For example, personal loans at banks may reach 20%, while in peer-to-peer lending they may be as low as 13%. This is because peer-to-peer lending companies are smaller, more efficient, and they pass most risks to lenders. Faster processing platforms rely on strong credit scoring systems using big data, social media activity, online transaction history, digital footprints, and more. The whole process is online. No paperwork. Borrowers rejected by banks may still qualify. This includes those lacking documents, considered too risky, having unreasonable loan purposes, or living in remote areas that banks cannot reach. For us as lenders, the advantage is we can earn very high interest, typically between 13% and 22% per year, much higher than deposits. Now the risks. The biggest thing to understand is that all default risk is 100% on us as lenders. Some major risks include credit risk. Borrowers may lose their jobs, their business may fail, their invoices may not be paid, or other situations that prevent repayment. Fraud and identity theft. Some people may apply using fake data, so we lose everything because repayment never happens. Platform shutdown risk. Fintech startups vary in size and stability. If the platform closes suddenly, they may not be able to collect repayments from borrowers. To explain more clearly, here are simplified examples, not including fees or tax. Assume we have 10 million. Scenario 1. We split it between two borrowers, each 5 million. Borrower A pays 14% equals 700,000. Borrower B pays 16% equals 800,000. Total profit equals 1.5 million, 15%. Everything goes well. Scenario 2, same as above, but after 6 months borrower B's business fails. They should repay 5.8 million, but only return 2.9 million. Borrower A still returns 5.7 million. Total returned equals 8.6 million. We lose 1.4 million equals minus 14%. Scenario 3 recommended method, diversification. 10 million is divided into 50 borrowers. Each borrower receives 200,000. Interest 16% equals 32,000 per borrower. If all repay, tota, es igual a 11.6 million, 16% return. If 4% of borrowers fail to repay, we lose 232,000 times 2 equals 464,000. Final amount equals 11.136 million, gives profit equals 11.36%. Still higher than deposits but requires lending to 50 different borrowers. From these three scenarios, it's clear that the risk is very high. A few defaults can immediately reduce or wipe out our capital if we don't diversify properly. Other things to consider before trying peer-to-peer lending. Downtime of funds. The time from depositing funds until the loan is fully funded and dispersed can take 15 days or more. If the loan fails to reach full funding or the borrower cancels, our funds remain idle, whereas in deposits or stocks we could have earned returns. Fees and commissions. Platforms may charge different fees, fixed fees, insurance fees, withdrawal fees, etc. You need to calculate how much these reduce your net return. Minimum lending amount. If the minimum amount per borrower is high, it becomes hard to diversify without large capital. In conclusion, peer-to-peer lending can be an interesting extra option for people looking to grow their money, but the risk level is very high. You must research carefully before trying it. Right now, I am personally testing peer-to-peer lending with Investory and CoinWorks. Once the borrowers finish repaying, I will make a video sharing my experience with both platforms. So don't forget to subscribe so you don't miss it. Thanks for watching, and if you have comments or ideas, feel free to write them below. See you in the next video.